The biggest story in finance and personal finance this year, the Fed. This first central theme, that we need to rethink the role of bonds in our portfolios, stems from this idea that based on what the Federal Reserve has all but declared it's trying to do, a recession is looking like a near guarantee. So, a little background. The Fed tries to make borrowing money more expensive when inflation is high to essentially get people to spend less. They want fewer dollars chasing the goods available. Now, this approach has been criticized by me and others because in a lot of ways, it seems like they're trying to force unemployment, and that tends to more negatively impact people who skew lower to middle income. But as we've discussed before, it's a rock in a high inflation print hard place because inflation also hurts wage workers. Where do bonds come into this? Well, when the Fed funds rate rises, so do bond yields. BlackRock's research is projecting that it's very unlikely that we'll see inflation return to pre-pandemic levels in 2023, and as a result, they have two major takeaways. Number one, put your cash to work through ultra-short duration securities, and number two, bonds are back. For example, in 2021, and to this report's point, for much of the last 10 to 15 years, you would earn 0.2% yield on a US 6-month T-bill. In 2022, it yielded 4.5%. If that is your risk-free rate of return, why would an investor who's trying to reliably generate income from their investments opt for all equities? How the turntables, right? A lot of the criticism of the 4% rule, which is the guideline that determines a safe withdrawal rate for retirees that says you should be able to withdraw 4% of a 60-40 portfolio annually and never deplete it 96-ish% of the time, hinged on a zero interest rate environment. The criticism claimed that in a world where fixed income yielded nothing, the 4% rule was dead. Well, maybe not anymore. Does this mean you should blow up your entire portfolio? Well, maybe, but maybe not. Here's Christy's take.
So we kind of have this joke internally that, it's been a thing that people have been talking about in markets for a long time. It was called TINA. There is no alternative. And so TINA was sort of the name of the game for the last 15 years. We're saying TINA's out and BARB is in. BARB meaning bonds are back. So that's kind of the tagline for how we're thinking about the year ahead and even, multiple years ahead. So I guess the TINA world was really characterized by this need to add a whole bunch of risk in a portfolio to get a decent return. So the world as it looked like in the past, sort of pre-pandemic, pre-interest rate hikes, meant that most things went up and they went up in tandem, but bonds didn't offer that much in terms of yields. So bonds were in this incredible, 40-year bull market, which means the price went up, but the yields went down. So bonds just really weren't a very viable option in most investors' portfolio. So when we spoke to investors, in particular, kind of back to that 54-year-old that you were talking about earlier, and especially on the retirement end of the spectrum, a lot of investors held bonds almost as a necessary evil. They thought of them as a hedge in their portfolio for when stocks went down, bonds were supposed to go up. 2022 was really, really difficult for a lot of investors because everything went down together. But where we are now, bonds have gone down so far that the yields are really attractive. And I think that can be attractive even for a 24-year-old. Instead of just thinking about it in terms of age breakdown, I would think about it in terms of risk profiles. So, not every 24-year-old wants to add a whole bunch of risk. Not all of their investment is necessarily going to be super long-term in nature. So right. I think what's attractive about bonds right now is that you can get something much closer to a guaranteed return. It's not going to be the 30% that we saw in the stock market last year, but it might be 5%. And so if you're thinking about, as a 24-year-old, are you investing just for retirement or are you investing to buy a house down the line? Do you have near-term investment goals? I think that bonds can fit really nicely into that sort of an allocation and a way to reach those goals.
So there you have it. Here's my take. I am not going to sell equities at a loss to rebalance, but I may consider what I'm going to call buy-side rebalancing in some of my accounts that are designated for short to medium term goals, where new cash that I add will bolster the bond allocation in my portfolio. So that's something I'll probably try to revisit when I do my annual asset allocation check-in at the end of this month.